Investing in stocks can be a great way to plan for retirement and build your wealth over the long term. But with so many different options available, it can be difficult to know where to start. To help you make the right decisions when it comes to picking stocks for retirement, here are some top tips from the Finance Channel on how to pick stocks that are good for retirement. 1. Find companies you understand. Investing in a company can be an important part of building wealth, but if you don't understand the business model and fundamentals of the company you are investing in, it can be a risky endeavor. That's why it is essential to take the time to find companies that you understand before investing your hard-earned money. By doing due diligence and researching companies, investors can gain insight into the industry the company operates in and the competitive landscape they are competing in, enabling them to make informed decisions about their investments. Investing in companies that you understand will not only help protect your capital but also help maximize returns over time. The following are some important considerations that investors should take into account when researching companies to invest in. Competitive analysis. The competitive landscape and the company's position within it will help you determine how well positioned the company is to succeed. Factors such as market share, industry growth rate, annual revenue, industry profitability, and product/service offerings will provide insight into what the future might be like for a company. A strong competitive analysis can help you determine whether there is room in the market for a new entrant or if there are competitors who pose a significant threat to your investment decision. Product/service offerings. The company's product offering will be a crucial factor in determining whether or not the investment has the potential to generate a significant margin. The product offerings section of an investment report will typically provide more specific information about what the company manufactures and sells, along with the pricing and volume information. 2. Determine whether a company has a competitive advantage. Knowing whether a company has a competitive advantage or not is crucial for any investor. It helps them to assess the company's performance and determine if it is worth investing in or not. Companies that have competitive advantages are better able to withstand changes in the business environment, remain profitable, and provide long-term returns for their investors. Therefore, it is important to take the time to evaluate a company's competitive advantage before investing in them. This can be done by analyzing their market position, resources, and capabilities as well as conducting competitor analysis. All these factors should be carefully considered when considering an investment decision as they will determine the success of your investment. It's time to start paring down your list of potential companies after taking into account a large number of them and their rivals. The most crucial quality to search for in a business is a long-term competitive edge, or what Warren Buffett refers to as a moat. Companies with sustainable competitive advantages that create value over time will outperform those without one, Buffett has said. A moat is a term coined by the economist Ronald Coase for an economic, organizational, or technological advantage that protects a business from the competition. Buffett has said that he buys stocks after thinking about what business is best suited to own the stock. Buying a stock like Coca-Cola would be a moat characteristic of Coke as it faces little competition in the beverage industry. The company's television, radio, and sponsorship deals have also given it an advantage over new entrants into the market. As Buffett looks for moat-like characteristics in companies, he says other factors that influence his decision are speed of adjustment to change and low capital intensity/high return on capital. 3. Determine your investing goals. It is important to take the time to determine your investing goals before making any investments. This will help you create a clear strategy and make better decisions that are in line with your long-term objectives. Knowing your goals will also help you identify the right types of investments and manage risk appropriately. Additionally, having a clearly defined set of goals will ensure that you stay focused and motivated throughout the investment process. Once you have a clear objective, you will know the amount of risk that is appropriate for your situation. When you know what type of investments to make and how much risk is appropriate for your situation, it will be easier to allocate money towards those investments and exit when appropriate. For example, if you want to buy a home in the next 5 years, and don't know where you will work or live after that time, investing in stocks would be appropriate. On the other hand, if you are confident that your employment situation will remain stable for the foreseeable future and there is no need to make any investments until then, investing in bonds may be appropriate to meet the goals of your plan. The bottom line, if you are on a budget, it is probably better for you to invest in stocks. This is because stocks generally produce higher returns than bonds over the course of your lifetime. However, if you have been able to amass some savings and feel confident that your investment portfolio will continue to grow over time, investing in bonds may be appropriate for you. From a tax perspective, bonds are generally more tax efficient because they provide you with a fixed payment over time. On the other hand, stocks fluctuate in price and can generate capital gains that are taxed at your marginal rate. 4. Determine a fair price for the stock. Before investing in a stock, it is important to determine its fair price. Knowing the fair value of a stock will help investors make informed decisions and not end up overpaying for a stock. This is especially true for beginner investors who may not have the experience or the resources to accurately evaluate the market. Determining a fair price for the stock will ensure that investors get the most out of their investments and minimize their risk of losses. While it is impossible for any investor to determine a fair price for a stock, there are several factors investors can use to help them decide on the fair price for their stock. These factors include 1. Previous fair prices. A trend in the market can indicate that a stock has been undervalued, and over time its fair value will increase. For example, investors would be wise to purchase shares of the Walt Disney Company, DIS, when they are currently selling at just over $80 because it has been consistently valued below $85 since its IPO in 1966. On the other hand, one should avoid investing in shares of Apple Incorporated APL over the long term because it has consistently been valued at over $100 since its IPO in 1980. 2. The value of the company. Investors will pay a higher price for companies with a net worth that is greater than their interest liabilities, and vice versa for companies with net assets less than their interest expenses, or shown by their balance sheets as negative assets. Companies with large reserves of cash or high-quality offerings like gold will also garner more valuation from investors if they have stable earnings and are growing at an even pace. 3. Market share. A company's market share is the percentage of a particular industry or market to which it belongs. In contrast, the sales share of a company is the percentage of goods sold within its industry or market that it owns. 4. Financial strength. A company's financial strength is shown by its ability to generate earnings and pay dividends on time and in full for investors who are buying stocks. Companies with poor credit ratings will have lower stock prices because the market believes that they may be unable to fully repay their debts in the future. 5. Company growth. A company's expected annual growth rate, measured as a percentage, will determine how fast it can grow by reinvesting profits back into the business. 5. Buy a stock with a margin of safety. Investing in stocks with a margin of safety can be a great way to protect your investments from potential losses. By buying stocks at prices lower than their intrinsic value, you can reduce the risk of losing your capital and earning more money in the long term. Furthermore, it is important to buy stocks with a margin of safety because it allows you to take advantage of market volatility and take advantage of market opportunities that may arise. Additionally, buying stocks with a margin of safety ensures that you are not taking too much risk for the potential reward. When investing in stocks, it is important to have a margin of safety. The term margin of safety is used to describe the range of differences between the value of an asset and its intrinsic value. A margin of safety is a range that differentiates between the risk and reward associated with an investment. The more risk involved, the less information you have about future returns. A low-risk investment would be buying bonds or holding cash. High-risk investments include stocks and real estate. If you are looking for a safe return, there is usually no point in taking too much risk for too small a reward.